Welcome to our Chinese Finance and Economy Briefing Program. Today, we dive into the ongoing tariff battle between the US and China, with observers suggesting that a swift resolution could be on the horizon if both nations resume dialogue. Despite recent escalations, including significant tariff increases, both sides remain open to negotiations, indicating a possible path forward. In other news, the Malaysian auto industry is bracing for impact as Chinese electric vehicle manufacturers initiate a price war. With companies like BYD and Nio poised to shift excess production to Southeast Asia, local firms face tough competition and potential job losses. The situation mirrors challenges seen in Thailand, raising concerns about the future of domestic automotive sectors in the region. Lastly, we explore the fierce competition in artificial intelligence between the US and China, particularly focusing on talent dynamics. While the US continues to attract elite researchers, China's rapid progress in producing STEM graduates and leading in AI patents is reshaping the landscape. This rivalry highlights the importance of adapting to retain top talent in this crucial field. Please stay tuned for more detailed insights. South China Morning Post: the recent escalation of tariffs between the US and China has raised concerns, but experts suggest that the conflict could resolve quickly if both sides engage in dialogue. President Trump has dramatically increased tariffs on Chinese goods, reaching as high as 156%, while China has retaliated with its own tariffs, totaling nearly 148%. Despite this tit-for-tat, analysts believe that both nations are still open to negotiations, which could lead to a swift resolution. Qiang, an expert from the University of Hong Kong, emphasizes that Trump likely cannot afford to alienate China, hinting at his ongoing interest in negotiations. Recent meetings between officials from both countries indicate that discussions may already be happening at lower levels, and if formal talks resume, a resolution could be reached within weeks or months. South China Morning Post: the Malaysian auto industry faces a looming threat from Chinese electric vehicle (EV) manufacturers, who are expected to flood the Southeast Asian market with their products as US tariffs impact China's economy. Industry experts warn that companies like BYD and Nio are likely to divert production to Malaysia, where they can offer aggressive pricing strategies that local manufacturers struggle to match. BYD's recent significant price cuts for its Atto 3 SUV have placed pressure on Malaysia's Proton, which currently leads the local EV market. Proton's executives express concern that a price war could jeopardize thousands of jobs in the domestic sector. The situation mirrors that of Thailand, where Chinese EVs dominate the market, highlighting the competitive edge that Chinese manufacturers have gained, particularly as they seek to expand into regions with less regulatory resistance. South China Morning Post: a complex rivalry is emerging in the field of artificial intelligence (AI) between Chinese professionals in the US and those in China. While the US remains a hub for elite AI researchers, a significant portion of this talent is of Chinese origin, contributing to leading tech firms and research institutions. This cross-border flow of expertise is becoming increasingly strategic as China ramps up its own AI capabilities, producing more STEM graduates and filing a majority of the world's AI patents. Despite challenges, such as visa uncertainties in the US, there is a growing trend of Chinese researchers returning home to capitalize on improved opportunities and institutional support. This dynamic raises questions about the future of AI development and the influence of cultural identity, as the next generation of innovators navigates between two distinct systems and visions for progress. The outcome of this rivalry may ultimately shape the foundational values of tomorrow's AI technologies. Nikkei Asia reports that China's four major state-owned banks are facing significant challenges as their earnings shrink amidst the ongoing trade war with the US. The banks have recorded historically low net interest margins, with the Industrial and Commercial Bank of China barely seeing profit growth in 2024. As the trade war escalates, the Chinese government is urging these banks to extend more credit to stimulate the economy, even as the amount of non-performing loans is on the rise, particularly due to the real estate sector's downturn. The precarious situation is exemplified by the struggles of China Evergrande Group, which has amassed staggering debts, raising concerns about a potential wave of bankruptcies that could further strain the banking sector. South China Morning Post highlights the warnings from Yu Yongding, a former advisor to China's central bank, regarding the safety of the country's overseas assets amid the escalating trade war. With US tariffs reaching unprecedented levels, Yu expressed deep concern about the potential for the conflict to extend into the financial realm, urging China to prepare for possible threats to its foreign assets. As China holds a significant amount of US Treasury securities, there are fears that the US might leverage these assets in a manner that could be detrimental to China. EU advocates for a strategic reduction in these holdings and emphasizes the need for concrete measures to mitigate potential losses, particularly in light of the recent geopolitical tensions. CBC reports on the volatility in global stock markets triggered by the intensifying trade spat between China and the US. Following an announcement of increased tariffs by China, markets experienced significant fluctuations, with Japan stocks initially plummeting before stabilizing. The US bond market also felt the impact, as investors reacted to the uncertainty surrounding tariffs, leading to a surge in Treasury yields. Despite a temporary reprieve from President Trump's decision to delay higher tariffs, market analysts suggest that investor confidence is wavering, viewing the move as a tactical pause rather than a genuine shift in policy. Amidst this turmoil, Chinese markets showed resilience, buoyed by diplomatic engagements, as China seeks to strengthen alliances in response to the trade challenges posed by the US. South China Morning Post reports that the trade tensions between the US and China have escalated to unprecedented levels, with the US imposing a staggering 156% effective tariff on Chinese imports, a significant increase driven by President Trump's aggressive trade policies. This includes reciprocal tariffs of 125% and multiple rounds of increases justified by accusations against China regarding the fentanyl trade. As a result, many Chinese exports may become economically unviable for the US market, prompting analysts to predict a breakdown in trade relations between the two nations. The situation is compounded as China retaliates, raising its tariffs on American goods to 125% and declaring an intention to ignore any further US tariff hikes, indicating a stalemate in negotiations and a potential long-term impact on global trade dynamics. South China Morning Post also highlights the resilience of ByteDance, the parent company of TikTok, which has reported a remarkable 63% increase in overseas sales in 2024 despite ongoing challenges in the US market. ByteDance revenue reached $39 billion, primarily driven by the popularity of TikTok, as the company expands its e-commerce initiatives in various international markets. This growth comes at a time when TikTok faces pressure from the US government regarding national security concerns, with potential divestment of its US assets looming. The company's strategic expansion into Europe and plans to enter new markets indicate its determination to thrive despite geopolitical hurdles, showcasing the adaptability of Chinese tech giants in the face of adversity. South China Morning Post further details China's recent decision to raise tariffs on American goods to 125%, mirroring the US's aggressive tariff strategy and declaring that any further increases from the US would be ignored. This move underscores the deepening trade rift and signals that China is prepared to endure the economic fallout while safeguarding its interests. Analysts suggest that this escalation effectively halts the import of American goods into China, with both countries facing significant challenges in finding substitutes for each other's products. The implications of these tariffs extend beyond mere trade figures, as they threaten to disrupt global supply chains and financial markets, with concerns that retaliatory measures could lead to broader economic instability. As both nations dig in their heels, the prospect of dialogue seems increasingly distant, raising alarms about the potential for a protracted economic conflict. Nikkei Asia reports that the global car industry is witnessing a striking divide, with China speeding ahead into the future while the West seems to be applying the brakes. Chinese electric vehicle (EV) leader BYD has introduced a groundbreaking charging system that can add 470 kilometers of range in just 5 minutes, while Xiaomi has launched a luxury SUV that outshines Western models in performance and price. In stark contrast, Western politicians are retreating from EV purchase subsidies and weakening emission targets, failing to grasp that vehicle electrification represents a crucial technological paradigm shift rather than just an environmental effort. BYD's innovative self-driving technology is becoming standard across its entire range, and over 60% of electric cars sold in China are already cheaper than gasoline-powered vehicles. This demonstrates that Chinese automakers have effectively tackled the primary challenges of EV adoption, such as cost and range anxiety. Meanwhile, the surge in EV registrations in countries like Thailand and Brazil is largely driven by Chinese brands, showcasing their global influence. The article emphasizes that electrification is merely the beginning of a broader technological evolution, with autonomous vehicles being the next frontier. China's rapid advancements in EV technology, including autonomous flying cars, highlight its potential to lead in manufacturing automation, while the West risks losing its competitive edge in the automotive sector and beyond due to complacency and a reluctance to embrace change. Thank you for tuning in. The content above showcases the latest briefing reports and analytical synopses, thoughtfully curated by the 6do team. These insights stem from a wide array of reputable media outlets, think tanks, government sources, and specialized experts worldwide. We encourage you to explore these sources for a comprehensive perspective. Keep in mind that while the content may not always align with the official standpoint of 6do Brief, it's not meant to be taken as absolute directives for decision-making. Comprising seasoned media professionals, learned scholars, and accomplished scientists, the 6do team embodies a trailblazing, fully independent media entity. To customize 6do Brief to meet your professional needs, you have the option to subscribe to a diverse array of briefings on our website, 6dobrief.com. Regardless of your location, you can conveniently receive 6do Brief via email.
Turn the lights on.